Hey guys, how's it going? So it's Tuesday, March 24th, 2020. We're right in the middle of the whole COVID-19 outbreak, shelter in place orders throughout California and most of the country. And I was actually on about a 3 or 4 hour long kind of mastermind session with the JX4 guys, talking about things that you need to do, or opportunities that you have, or areas where you may find yourself in trouble. And one thought that came up to me today is, if you have a home equity line of credit that you're using, that you have anything drawn on, you need to take a look at your paperwork and see when that goes amortizing. What's that mean? Here's the way most of those work. You might get it for a 30-year loan, and it will have usually either a 5 or a 10-year draw, and then it will amortize over the remaining term. So if you had a 10-year draw, let's say you got that HELOC 10 years ago in 2010, okay? So let's say you had a 10-year draw and it's coming due right now. Your payments are going to more than double from what you're paying right now if it starts amortizing over just 20 years, as opposed to your 10-year interest only that you've been paying. And if your income is down, that could be devastating. You know, if you don't have enough reserves set up, it's always a good idea to have at least 6 months reserves liquid, just sitting there as kind of an emergency fund. Most people don't have that, and it's probably not realistic for most people to think that they have that now. Although, when you remember all the issues and the difficulties that we had at this time, it would be a good idea for you to make sure that you get that taken care of for in the future. So before this becomes a cash crunch, a crisis for you, what I want you to do is make sure you know when that's going to start amortizing. Make sure you know under what terms it's going to start amortizing. And if you need to go back and have it rolled into a new HELOC, try to do that right now. These lenders are going to get busier. They are very likely to start restricting getting new home equity lines. Another thing for you to keep in mind, this happened a lot back in 2007, 2008, 2009. A lot of the banks cut off the home equity line limits, period. And they shut down the draw periods, and they cut your limits to whatever you owed. So if you have something where you think you're going to be needing access to any of that money in the immediate near future, take it out now and put it in the bank. The reason I say that is you don't want to be counting on that debt vehicle being available for you to be able to make your payments on things, and then all of a sudden the bank just turns off the switch on you. Because if this gets bad enough, they're going to do that. Those equity lines have provisions that let them do it. And I don't know if you remember 10 years or so ago, I used to bank at Bank of America during that time heavily. And they actually had laminated cards at each teller station with their bullet points apologizing and explaining why your home equity line was taken away from you. I had lots of clients that had large equity lines back at the time, and they were surprised to find that they didn't have access to it. Something else you need to consider is, if you think there's any chance that your employment is not secure, that you could lose your job, that you could get laid off, you might want to do a cash out refinance right now, just as an insurance policy. Put some extra money in the bank, build up that savings, and have the opportunity available to you. Because if you get to the point that you're in trouble, when you're in trouble, nobody's going to loan you the money. So you want to be making those defensive maneuvers and adjustments while you're strong. For those of you that are older who might be considering taking out a reverse mortgage to get yourself past issues right now, a lot of people who are retired have seen the money in their retirement accounts just dwindle with the bloodbath that's been happening in the stock markets. So if you're coming up towards a cash crisis there, you might want to look at doing a reverse mortgage before you run out of money. Here's something you need to keep in mind. You can't have ever paid your mortgage or your property taxes or your homeowner's insurance late at least in the last 24 months before taking out a reverse mortgage, because they're going to check that to make sure that you have the wherewithal to keep making your payments. And what's going to happen is, if at any time in the last 24 months you paid any of those things late, even on accident, they're going to force you to set up what's called a life expectancy set aside out of the proceeds of that reverse mortgage, which means they're going to calculate how much longer they think you're going to live. They're going to calculate out your homeowner's insurance and property taxes for that number of years. They're going to add some other amount to that and say you have to set that portion of your reverse mortgage proceeds aside. You don't get it. As it gets spent, you keep paying increased interest on it. It gets added to your principal, but you don't have access to that portion of your funds. And frankly, I've never seen one of my clients who was ordered to have a life expectancy set aside actually have enough equity to make the loan work. Okay, it's not a real good situation. Now, I haven't done enough of those to where I've seen them, but I have, in 5 or 6 different cases, seen banks try to require that we set up the life expectancy set aside, and it's killed the deal in every case. There just wasn't enough equity left to do anything with it. In fact, in one of the cases, it was a worse reverse mortgage that we were trying to get them out of. We were going to pay all the closing costs. They were going to get access to more money, and the rate would be lower. So that total that's accruing on their total debt would accrue more slowly, but because they triggered the need for the life expectancy set aside, all of a sudden there was no money to do anything with, because it would have required over $100,000 being set aside for those purposes in this case, and he didn't have that kind of equity. So again, make sure you pay everything on time right now. I saw something from a debt attorney today saying, whatever you do as you're doing this, don't go emptying your retirement accounts to pay off your consumer debt right now. As a matter of fact, if you're in that kind of a situation to where you're considering things of that nature, you really should talk to a bankruptcy attorney first and see what your options are. And something else, if you're getting to the point that you're running into trouble with your finances, don't ever, ever, ever sign up for a debt relief program. Anytime that comes up, that's my advice to you. I have seen many people who have signed up for programs like that who regret it so much years down the road, because it's devastating. What those programs do is they actually change your billing address for all your accounts to their office, and then they stop paying all your bills. Well, they collect money from you, and then they try to use that money months or years down the road to negotiated payoffs with the banks, and then they get to keep whatever's left. So they're not real generous with the money you paid in, and then you also get a 1099-C for the debt forgiveness, and that's just another nightmare. Anyway, I didn't mean to go off on that tangent, but you have options available to you right now. And if you think you're heading towards something that's going to be trouble, let's see what you need to do, what steps you need to take, and what options you have available to you now so that you can avoid that. I think this is going to be very temporary, and I want to make sure you get out on the other end of this as unscathed as possible. Let me know if you have any questions, and I'll be coming back at you soon with more information. Thanks, guys.